The cash value of an IUL can equal and exceed the original death benefit in as little as 12 years into the policy. In this educational episode, I'm going to address the myth that an IUL insurance policy will implode, what sometimes they say will crash and burn, lapse. You can't afford it anymore as the older you get. So as you get older, it's going to cost more and more to where you can't afford it. It's going to blow up. Nothing could be further than the truth. Get ready. I'm going to dispel this myth. So I'm Doug Andrew, and I've been helping people optimize assets, minimize taxes, and empower their authentic wealth now for 5 decades. But when I do this, it's helping people accumulate money. Tax-free is my favorite method, and then be able to access that money tax-free during their working years. But when they retire, to be able to turn on tax-free income that will last as long as they do. Now, being a retirement planning specialist for now 5 decades, I have noticed that there are 3 big dangers that cause most retirees to outlive their money. And it's been true for all 5 decades. Taxes, inflation, and market volatility. As of the recording of this episode, we're being hit with all 3 of those at once. And so people get concerned because they will outlive their money. Inflation, when it starts hitting 15%, which is what it was last year as of the recording of this episode. Now, I don't care if the consumer price index was only 8. You need to triple that because of the way they report inflation. They don't include things like the cost of gasoline and so forth. And they can compare the price of an 8-ounce filet mignon steak last year to hamburger this year. They passed those laws back in the 1980s so they wouldn't have to pay Social Security recipients the real cost of living increase. But we have to deal with inflation at 15% now, divided into the rule of 72. Your cost of living is going to double in 4.8 years. So if you can get by on $100,000 a year now, in less than 5 years, you're going to need $200,000 to buy the same gallons of gas and loaves of bread that $100,000 buys today. So inflation takes its toll. Taxes, you have $1 million nest egg, and if you need a net of $100,000 after tax, you have to pull out $150,000, pay tax of a third, 33% tax bracket between federal and state, to net $100,000 to buy gas and groceries. Well, if you're earning even a 10% rate of return, $1 million nest egg is going to drain dry in 11 years. You're going to outlive your money. See, I would rather have $1 million nest egg in an IUL policy that can generate 10% tax-free. I want to have $100,000 a year of tax-free income, and it doesn't matter if I live 30 years, I still have my million in there, but I got several more years, 20 more years of $100,000. That's a $2 million better retirement strategy. Plus, I still have the million. It's a $3 million better strategy than the same amount of money in an IRA or 401k. Does that make sense? And then we don't want to have our money at risk in a volatile market during retirement. We need predictable income. We can't have heartburn over the market going down. So many times we have critics out there that don't understand IUL. And so the myth starts around that an IUL insurance policy is just going to get more and more expensive as you get older. It's going to crash and burn. And I can't believe how many insurance agents believe that because they're only selling whole life insurance. And whole life insurance has these guarantees in it. They have to pay more money into it. The rates of return, if you're using whole life insurance for retirement benefits, ask the whole life agent to give you an illustration of the tax-favored income on a whole life policy starting at age 60 or 65 and see how much they can generate to maybe age 120. I can have an IUL policy blow them out of the water because whole life was primarily designed for death benefit on that kind of a chassis. Can you use it for living benefits? Yeah. But if you really want to use an insurance contract for living benefits to be able to earn rates of return that are usually at least 2% higher than the same rates of return in whole life, and have the costs be only 1% of the actual gross rate of return. What am I talking about? Do you know that ever since 1980, I've averaged 9.62? So if I'm earning 9.6, I'm netting about 8.6 cash on cash. Only 1 percentage point of the money that I've been earning is paying for the cost of the insurance retroactive back to day one. But because I've been using rebalancing and diversifying, my actual rates of return, especially since indexed universal life was introduced in 1997, the average return has been 11.17 and netting 10.07. So if I own a universal life insurance contract and I put in 500 grand and it doubles to $1 million, and then $1 million doubles to $2 million, and some people it doubles to $4 million and $8 million, the actual cost of insurance is now next to nothing. And a lot of agents go, what are you talking about? Because they're used to whole life insurance, or maybe somebody who set up a universal life on an increasing death benefit and never changed it after it was funded. I address these issues in other videos. So let me explain it this way. When you set up an IUL policy correctly, you want it to accumulate your money tax-free under Section 72E of the Internal Revenue Code. Whenever you access money, you want to be able to do that income tax-free under Section 7702. And at the end of the day, when you die, you want anything left in the policy, the cash value, to blossom and increase and transfer tax-free. You want it to transfer tax-free. Now, in order to do that, you take the least amount of insurance the IRS will let you get away with, and you put in the most premium the IRS allows, because your goal is to self-insure. You want your cash value to equal or exceed the death benefit within 12 years, no longer than 20 years. And I can't believe how many insurance agents don't know how to do that. And so you have to comply with 3 tax citations, the Tax Equity Fiscal Responsibility Act of 1982 and the Deficit Reduction Act of 1984. These spell acronyms TEFRA and DEFRA. This dictates the minimum amount of insurance based upon your age, gender, and your health that's required on the account to accommodate the amount of money you want to put in there to grow tax-free for your retirement, okay? Or whatever goal you're doing it for. Now, TEFRA and DEFRA gives parity. If you're older, if you're 55, 60, 65, 70, 75. I had a 78-year-old friend of my family in 1980. He had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters predeceased him, and 3 brothers. And so he was rated Table D. That means the actual cost of insurance is double what it is for normal people. That wasn't the objective, is the insurance. So we were able to cut down his insurance benefits substantially so that he could put in his $500,000 and earn 11 and net 10. So he could immediately start pulling out 50 grand a year tax-free, because this is pre-TAMRA. In 1988, the TAMRA law was passed because the banks and the brokerage firms couldn't compete with these. These are safer, they pay higher interest, they're tax-free, and they blossom when you die. Banks and credit union accounts don't do that. So TAMRA is the Technical and Miscellaneous Revenue Act of 1988, and it means that if you want to have tax-free income, you've got to spread out the funding over 4 years and 1 day if it's universal life and you're over age 50, basically. If it's whole life, you have to take 6 years and 1 day, or 7 pay. It's called the 7-pay test. So I've often used this metaphor of a bucket. So you're designing an IUL like a bucket, and you want to accommodate the amount of money you want to put into it. Okay. And so if you're repositioning over the next 5 years, let's say, $500,000, and it can be for $1 million, it can be for $500 a month. But let's just say it's an older person and they're repositioning money. They're rolling money out of an IRA or 401k. Maybe they're selling a rental property. They're sick and tired of being the landlord on. Maybe they're repositioning money. They got a settlement from a car accident, or maybe it's money sitting in a bank or credit union earning a pathetic rate of return of 2 or 3%. So they come up with $500,000. According to TEFRA, DEFRA, and TAMRA, they can only fill it up about $100,000 a year. $100,000 the first day of the first year, the second day, the first day of the second year, and so forth. So in 4 years and 1 day, technically, they could get their $500,000 in there. Now it's sort of grandfathered to be tax-free forever after when you access money under Section 7702, okay? Now, here's what a lot of agents don't understand. They think that this client is going to have to pay for $1 million of life insurance the rest of their life. Well, if this performs well, that's not a big deal, but if they earn 11, they might only net 7 or 8. I'm a perfectionist. If they earn 11, I want them to net 10% retroactive back to day one. And so I use the level death benefit. A lot of agents, they don't understand this, that, they hear phrases like level is the devil. No, if you're in your 30s and you're socking away $500 a month into one of these, then you use the increasing death benefit until when? Until you stop putting in $500 a month and you're through funding it. Then you switch to level death benefit. If you want the spigot on the bucket to get smaller as you get older. What's that? The cost of the insurance. You ever seen an insurance policy that gets cheaper as you get older? Well, then you haven't seen one designed like this, because it will not crash and burn. You will self-insure in as little as 12 years. Here's how. If I get my $500,000 in there in 4 years and 1 day, okay, and if I earn, well, let's just stop at that point in time. If I have $500,000 in there, and it's going to be a little bit more than that because it's earning interest while I'm filling it up, at that point in time, under the level death benefit, the net amount at risk is now only half of this million, because $500,000 of that $1 million death benefit is my own money. I've self-insured. See, the whole end goal of buy term invest the difference is to be able to have enough money that you can get rid of the insurance. Accumulate enough money that equals the insurance. That takes 30 or 40 years with buy term invest the difference strategies. Here, in 5 years, $500,000 is half of the death benefit. The insurance company is only charging me on the spigot on that bucket for half as much coverage as they were charging me 5 years earlier. And even though I'm 5 years older, the cost of insurance hasn't gone up that much. The interest I'm earning on $500,000 is beginning to dwarf the cost of the insurance on the net amount at risk. Where did I get this million? That's under Tefra and Differ. That's the minimum death benefit for a 60-year-old, okay? You can buy way more life insurance than that for $500,000. That's not the objective. So if I'm earning 9.6%, let's say, you divide that into the rule of 72, your money will double in 7.5 years. Many of our clients that have IUL have earned higher than that. But let's just say they're netting 9.6. And so this is going to double to $1 million in another 7.5 years. So in the 12th year of this policy, their cash value, the $500,000 has now doubled to $1 million. The cash value equals the death benefit. Huh. How much is the insurance company at risk for now? Nothing. Tefra and Defra says if you happen to die, they need to pay out 5% more than that, $1,050,000, but they're only going to charge you for $50,000. The cost of insurance for $50,000 compared to the interest you're earning on $1 million is minuscule. See, $1 million, there's some years that our IUL policyholders have capped out at 25%. On $1 million, my client in 2017 made $250,000. So he made $250,000 on his $1 million. And the cost of the insurance, because he was self-insured, was only like $3,000. It's minuscule. It's not even, it's negligible. So what happens when the $1 million then doubles if you don't need to start taking out income? If you needed to, you have $1 million in there, you can start pulling out $100,000 a year without depleting principal based on actual history. But if you're not ready to take out income, you want it to keep growing tax-free, $1 million should double to $2 million within what? Another 7.5 years. So now we're talking about the 20th year into this policy. The cash value is $2 million. The death benefit, if you die, is $2.1 million. But the insurance company is only charging you for $100,000 net amount at risk. The cost, even though you're 20 years older, for $100,000 of insurance compared to earning 25% in a given year on $2 million, that's $500,000. It's minuscule. So see, when agents who sell whole life go, no, index universal life, it'll crash and burn, it'll implode. The cost of insurance will make this thing crash and burn. I go, you haven't seen one structured correctly. You don't even get it. They don't realize that the cash value oftentimes within 12 to 20 years grows to equal and exceed the death benefit. So the cost of the insurance is really nothing. In other words, when a whole life agent says, well, with whole life, you get guarantees. Guarantees for what? Guarantees that the death benefit will stay in force until you die. Well, it looks like with my IUL, I got that guarantee within 10 years. So what does it mean to guarantee that when this keeps growing and my death benefit goes up to 2 million, 4 million, 8 million? Why do I need whole life guarantees? See, a lot of times they simply don't know what they don't know. So if this is helping you make a decision, I want to gift you a copy of my most recent best-selling book. It's called The Laser Fund, and it's been flying off of our warehouse shelves. And you can go to Amazon and purchase one for $20, and you'll pay another, $10 for shipping and handling. If you do that, thank you. But I'll gift you a copy for free. Simply go to laserfund.com or click on the link below. And when you get in there to claim your free copy, you contribute a nominal amount towards the shipping and handling, okay? I require a little bit of skin in the game. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. When you're in there claiming your free copy, check out the audio and video formats if you like to listen and learn or watch and learn. There's also educational webinars we do on a regular basis. They're free. You can register for one of those. Also, you can even schedule an appointment with an IUL professional that I oversee that has passed a proficiency exam, and they can talk with you, meet over GoToMeeting or a Zoom meeting or call you, whatever you like to do. And they will set up one and create illustrations at no cost or obligation. Does that sound fair enough?